Hi, I'm Mark Kramer. I'm a senior lecturer at Harvard Business School, and about 20 years ago, with my colleague Professor Michael Porter, I started a social impact consulting firm called FSG. The firm originally was named Foundation Strategy Group because the idea that Michael Porter and I had was to bring serious strategy consulting into philanthropy. And so we started the firm and we began to work with foundations from around the world. And after about a year, Shell Oil Company came to us to help their foundation develop a strategy, a familiar name here in the Netherlands. And the more Michael and I thought about the Shell Foundation, the more we realized that the company would have infinitely more impact on social and environmental issues than the foundation ever could have. And that began to make us think about how companies impact society. But the more we thought about it, the more we realized that social conditions also determine the competitiveness of companies and the success of companies. And that led us to think about this interdependence between a successful society and a healthy business. And that led us to this concept of creating shared value, an article that we published about 10 years ago, and a course that I now teach at Harvard Business School. I'll give you a quick example, which is the case that I start the course with. It's a life and health insurance company out of South Africa called Discovery. Now, Discovery has a social purpose. They want to make people healthier. But they've actually found a way to bring that purpose to life. They've developed a set of behavioral incentives that actually lead people to engage in healthier behavior. So, for example, if you join Discovery, you get a free Apple Watch. But you have to set a weekly exercise goal. As long as you meet the goal, you get a free Starbucks coffee. But if you don't meet the goal for a few weeks, you actually have to give the watch back. And it's designed that way because people's aversion to losing something they have turns out to be a stronger motivator than their hope to get something that they don't yet have. Well, because of all of the incentives that they've created, Discovery's insured population actually has 15% lower healthcare costs and a 10-year longer life expectancy, which makes Discovery a more profitable insurance company. And they've been able to build up 40 million life years of data that correlates the incentive with the behavior change, with the health outcome, with the difference in cost. That's data that no other insurance company in the world has. And it's enabled them to really disrupt and reinvent the life insurance business by not just spreading risk, but actually reducing risk. We think it's a great example of a company that has gained a competitive advantage through a positive social impact, and that's the essence of what we call creating shared value. Now, what's interesting from an investor perspective is that starting about 5 or 6 years ago, Fortune magazine began to publish an annual list of 50 companies changing the world. It comes out every August or September. And by and large, those are companies that are creating shared value. And we looked back at the list and we found that over 5 years, the companies on the list outperformed the market in the year after publication by about 4%. Now, what's interesting is that these companies are not necessarily the ones that show up at the top of ESG rankings or that one would necessarily find in socially responsible investment funds. And yet somehow they're delivering a positive impact in a way that is actually generating value for their shareholders. And the more we looked at it, the more we realized that this is quite a different exercise than looking at ESG rankings and ratings. For one thing, when companies fill out their ESG rating forms, they're looking at scores of different issues, every possible impact the company has on environmental and social conditions. And of course, most of those issues are not really material to the company's performance economically. And in many cases, the company's impact is not material to the world. So you can look at the carbon footprint of a bank, but honestly, that's not what's going to make a bank more profitable. And honestly, the bank's carbon footprint isn't a major source of greenhouse gases in the world today. So when you begin to pull back and not look at all of the GRI factors with equal weight, but begin to focus just on the factors that are material. And of course, the Sustainability Accounting Standards Board, SASB, has developed for many different industries a list of which are the material, social, and environmental factors for that industry. Now, recent research shows that when you focus on companies that are investing in improving their performance just on the material GRI issues, those companies actually outperform the market and outperform their peers by 3 to 6% a year, a really meaningful alpha. And of course, it makes sense. If companies focus on the issues that matter to their business, they will have a greater positive impact on society, and it'll have a greater economic benefit for the company. But the other thing we noticed about the SASB criteria is that over time, sustainability practices within an industry begin to converge. So if you're a logistics company like DHL or Federal Express, you're going to be very focused on your carbon footprint, your use of fuel and energy. It's a material factor. But everybody in the industry is going to begin to do the same things to try and reduce their fuel consumption and their carbon footprint. And so at the end of the day, you've kind of raised best practices for the industry, but no single company has really gained a competitive advantage over others. So we began to think, if you go beyond just materiality and begin to think about competitive strategy, are there companies that are achieving a competitive advantage because of the positive social and environmental impact they have? Well, the Discovery life insurance company out of South Africa is, of course, a perfect example of that. But the more we looked around, the more we found other examples of companies that are doing similar things to gain a competitive advantage. So just to pick a few quick examples, MasterCard, a number of years ago, realized that their competition wasn't just American Express and Visa, but that the real opportunity for them was financial inclusion for the 3 billion people in the world who don't have access to credit or financial services. And they have focused on reaching those markets rather than competing head-to-head with Visa. And it has been a very successful strategy for them. Or there's a company, DSM, also in the Netherlands, which has focused on developing new products that help advance progress toward the Sustainable Development Goals. That is the filter they use in their product development lifecycle process. And that has given them tremendous opportunities for growth and a very successful performance for their stock. To take just a couple other examples, Maersk, the shipping company, has redesigned their ships in unique ways to be much more energy efficient and has worked on trying to reduce red tape in the ports around the world where they import and unload goods. That has been a competitive advantage for them. And there's a company, Xylem, that has focused in on the waste of water, of fresh water, because about a third of water is actually wasted through leakage in pipes and so on. And they've developed sensors that are software-driven that enable municipalities to identify where there is waste, where there are leaks, and reduce the loss of fresh water. So looking around the world, Professor Porter and I find more and more opportunities where companies can create shared value, gain a competitive advantage, improve returns to shareholders by having a positive impact built into their core competitive strategy. This is something, by and large, that the investment community has missed. You know, for a long time, there have been people who have done an outstanding job of financial analysis of companies, but have largely ignored social and environmental issues. And there are people who've done a phenomenal job of looking at the social and environmental impact of companies, but they've ignored the financial performance. Creating shares value says you need to look at both. And rather than treat ESG as a risk factor, which is what most investment firms we've studied do, You need to focus on it as an opportunity for growth and differentiation. So most investment companies come up with their list of desirable companies through security analysis, and then at the final stage do an ESG screen to eliminate those that are poor performers on the grounds that those might be riskier. Well, the most successful shared value investing companies, and there are very few, start by looking at a roadmap to a sustainable planet. What are the global trends that are shaping the environmental and social issues in ways that will impact business? Things like climate change, things like nutrition, things like non-communicable disease, things like the productivity of smallhold farmers. They focus in on these big issues that are really shifting industries, and then try to identify within that who are the companies that are positioned to succeed in this new world. So in order to really capture shared value for the sake of improving investment returns and improving social impact of business, investors have to act differently. But we've also seen that companies have to act differently, because companies are not communicating to investors the economic value of the shared value they create. I'll give you one quick example. Enel is the Italian power company, and they have shifted to 50% renewable energy at this point, and they are committed to going to 60% and 100% over the next 20 years. They have made a big deal about this shift to 50% renewables, talking about how it helps advance the Sustainable Development Goals, and talking about what a great company they are for the world because of that. What they haven't pointed out is that the return on invested capital and the profit margin on renewable power is 6 times greater than on fossil fuels. And so their move to more renewable energy is actually improving their EBITDA over time. They haven't actually made that connection in their presentations to investors. But we see example after example where what companies are doing in creating shared value is actually generating benefits for shareholders. And yet company management is still talking about their social and environmental issues in their sustainability report as if it's part of improving their reputation, and not converting the benefits into the value for shareholders. I'll say one last point. We often talk about the social responsibility of companies. We very rarely talk about the social responsibility of investors. But investors, too, have a social responsibility. They can make money in ways that extract profits from society, that result in unemployment and layoffs, that create greater pressure on workers, that create cheaper products or unsafe products or unhealthy products. Or they can allocate money to the companies that are helping to solve society's problems in a profitable way. There's been tremendous momentum around the idea of impact investing, and that is something we very much favor and believe in. But what impact investing means for public equities is still quite unclear. We think the opportunity is for investors to become part of the solution by channeling their investments into public companies that are creating shared value. Professor Porter, Professor Seraphim, and I have written an article in Institutional Investor that sets out these ideas more fully. It's called Where ESG Fails. I invite you to take a look at that. We've also set up the Shared Value Initiative at FSG, and I invite you to visit that website and find more resources about shared value investing and shared value companies there. And I hope that you have a terrific conference. Thank you very much for letting me be with you today.